A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets on one side and the company's liabilities on the other side. The difference between the two is the company's equity. To analyze a balance sheet, there are several key things to look at. Start by looking at the company's assets. Are they diversified, or is the company heavily reliant on a few specific assets? Are the assets liquid, or can they be easily converted to cash? Is the company's asset base growing or shrinking? Next, look at the company's liabilities. Are they short-term or long-term in nature? Is the company heavily reliant on debt financing? Is the company's debt burden increasing or decreasing over time? The next thing to look at is equity. The equity section shows the residual interest in the assets of the company after liabilities have been settled. It can be divided into two parts: shareholder equity and retained earnings. Shareholder equity represents the ownership interest of the company's shareholders, while retained earnings represent the portion of the company's profits that have been reinvested in the business rather than distributed to shareholders. Next, you should look at the working capital. Working capital is a measure of a company's short-term financial health. It is calculated by subtracting current liabilities from current assets. A positive working capital means that the company has enough short-term assets to cover its short-term liabilities, while a negative working capital means that the company may have difficulty meeting its short-term obligations. You should also look at the debt-to-equity ratio. This ratio compares a company's total liabilities to its shareholder equity. A high debt-to-equity ratio may indicate that the company is taking on too much debt, while a low debt-to-equity ratio may indicate that the company is financially conservative. By analyzing these key elements of a balance sheet, you can get a better understanding of a company's financial position and its ability to pay its debts as they come due.